Tesla stock, the pain continues. Tesla just broke $150 a share. This is an absolute key level for this stock. This is a line in the sand for the bulls and the bears. The bears are trying their hardest to get this baby and want to get this baby under 150. The bulls are trying their hardest, at least as far as the short-term bulls, to try to keep this thing above 150. So this stock just hit 40% down for the year, folks. 40%. We've got people flipping so negative on Tesla. It's pretty incredible. I mean, every time you think the sentiment around Tesla can't get any worse, it gets worse. Longtime Tesla bull downgrades Tesla. Here's why. So we're going to speak about this Deutsche Bank note, hear what he has to say in regards to that, and kind of talk Tesla here at the top of this video. Then we're going to get into this one. Meta, my biggest investment, strike to a partnership with Google. I think this should be very interesting. Then we're going to get into this video. Stephanie Link buys D.R. Horton and Las Vegas Sands. Interesting, to buy a home builder at this point in the cycle. So we'll speak about that. That should be interesting. And then the last video I want to react to is this one, Zoom. So Zoom's actually a stock that's interesting to me. It has a phenomenal income statement and an absolutely amazing balance sheet. And so it's actually a pretty dang interesting investment potential here. And the valuation is very, very cheap for this stock. So I'm interested to hear why they're upgrading Zoom here today. Appreciate y'all joining me as always. Thanks so much for being here. Thank you for smashing that like button, folks. I appreciate every single person that smashes that like day in and day out. You don't even know. It means so much to me. And also thank you everybody who subscribed, new all-time high subscribers. Hey, 1000X. So we already got 70 plus people on the wait list for 1000X. If you want to join the wait list for 1000X, go to 1000xstocks.com. You can join the wait list there. We should be 100 plus here very shortly. Let's get into this.
Now, Emmanuel, it's great to have you. I was looking back to early March where you actually were suspicious of the delivery number ahead of that print, and you talked about downside risk. Why revisit the rating at this point?
Yeah, thanks so much for having me. So, look, we've actually been at the forefront of warning investors about meaningful near-term downside risk. Basically, Tesla is under tremendous pressure. There's a lot of pressure on the demand side for their vehicles, pricing pressure, earnings pressure, free cash flow. So if anything, we've had some of the lowest estimates in the near term, both for 2024 and 2025. But we've been okay with it as long as it was perceived as being temporary. And it would have been temporary because the Model 2 was supposed to come next year and re-accelerate things, re-accelerate volume, margin, earnings, and free cash flow. I believe long-term investors are on board as well. They know how bad things are now, but they expected things to turn around. Now that Model 2 is likely being pushed out, potentially even canceled, you do not have this on the horizon anymore. And so now...
Hold on. Wait just a flippin' flapjacking moment. Wait. Model 2 canceled. Elon Musk already got rid of that whole drama about that being canceled. He already got rid of that idea. So the fact that you're going to run with something when the CEO of the company says it's complete baloney, who you would rather believe? Reporters that aren't even inside the company rather than the CEO of the company? That's crazy talk. That's crazy talk. Also, the car market in general is not good. Did you guys see CarMax? CarMax. Look at this. This is CarMax stock. CarMax stock, this is less than a month. Okay, so we can call this about 3 weeks or so, 3 to 4 weeks. This stock is down 22% just in the past few weeks, folks. CarMax numbers came out. They were not seen as favorable. There was weakness all throughout their numbers in general, and it doesn't look like it's going to get better in the short term for CarMax overall. So the fact is right now, and look at that Tesla, it's right under 150 right now. It's a battle. It's a battle for that 150 number. The auto market is not good right now. And if anything, it looks like it's going to get worse in the short term. You're going to see this from all the automakers. It's going to play out over this next, I can tell you, over this next few quarters here. A lot of these big automakers are not going to report good numbers. The auto dealers are going to report weakening their business. And so, I think a lot of people are trying to put this on Tesla like, oh, Tesla has problems. They're about to see, no, we have auto sector problems.
He's under pressure. Free cash flow is under pressure.
They'll see
There's
very
no
shortly.
turning point to this. Hence, this is thesis changing, and this is why we're downgrading the stock.
They're already seeing it.
No
CarMax down 22% in a few weeks.
Or
They're already
valleys
seeing it.
between innovations. You think this is more structural?
This is essentially a function of an aging product lineup. So the core product lineup of Tesla is old. It's facing increasing competition. It's also facing larger headwinds around EV demand, especially in the US.
Oh my gosh, what is he talking about? The product lineup's old? So isn't the F-150 lineup, okay? that means nothing. So isn't the Corolla. So isn't the Honda Civic and the Honda Accord. Those are all old. They refresh. As Tesla's just refreshed the Model 3 recently, refreshed the Model Y recently, the S and X recently. So, like, an old product lineup, like, what are you talking about? Like, the auto sector, you can, as long as you have refreshes from time to time, you can keep on that cycle for decades. This is an old product. This is called an iPhone. The first one came out in 2007, right? But Apple refreshes it. And they come out with little chips and it's a little better and the camera's a little better. You know what I mean? Like that's how this game's played. They're still selling plenty of iPhones in 2024 and they'll still be selling plenty in 2027, 20 years after the product came out. Like, Model 3, Model Y, those vehicles haven't even peaked, in my opinion, not even close in terms of sales numbers, right? The S and X, those are always going to be more niche vehicles. The Cybertruck's not even remotely close to peak sales volume in regards to that. And then Model 2 is going to be insane whenever that finally releases.
And as a result, the volumes at Tesla are now less than flat, right? Q1 was already down. Q2 could also be down year over year. That's despite massive price cuts over the last 18 months or so. And so, yes, it is structural. It is not cyclical. It could have been solved by having essentially a new product at a low price point, which would have been attractive and frankly could actually have been...
No, disagree completely. Structural. There's a difference between a short-term hiccup and a trend. A trend is something that goes on over a 3-year span, 5-year span, 10-year span, okay? Where's Tesla's demand gone over the past 3, 5, 10 years? Up. We have a short-term hiccup here in sales volume, which is not the first time this has happened. This has happened to Tesla several times in its history. This is not the first time they had a sales hiccup. This is just one of many times they've had a sales hiccup. And so to, assume that what's going on short term with the company is going to continue to go on is just, you can make that bet, but good luck on that because in 2 years from now, you're going to see Tesla's revenues are a whole lot higher than they are today. The volumes are a whole lot higher today. And then people are going to be like, oh, what happened?
At a $25,000 price point. This would have been the Model 2. If this is not coming, we're talking about the same old lineup for the foreseeable future.
Same old lineup?
With all the eggs being put into the robo-taxi basket, this is not a consumer vehicle. We believe that this creates much downside to earnings and free cash flow estimates for the foreseeable future.
Yeah, well, that was reflected in what is now your $2.40 estimate, $2.40 for 2027. But Emmanuel, I noticed that your price target is based on a 42 multiple, and I just wonder why is that warranted, given from here to there's not a lot of growth to speak of?
Yeah, so you're really right on both counts. Basically, our view is with the current lineup of vehicles, the best Tesla could do is around $2 of earnings, probably for the foreseeable future. So call it till 2027, maybe even beyond or so. And there's downside risk to that as well if pricing continues to come down or if volumes sort of collapse. The thing is, it's not like Tesla is, shutting its doors. They're now going all in on robotaxi. We do a deep dive on robotaxi in the notes. We're not going to go through it now, but the point is, it's hard to put into numbers, and it's certainly not into our earnings model. But that optionality is very much there. It would be highly differentiated, and we think that we should at least account for it in the multiple. So the multiple is punchy despite no earnings growth, because in the end, investors in Tesla will basically say, okay, I understand the core business is no longer growing, potentially even shrinking, but look at how exciting this business could potentially be. Our rating, though, indicates this is highly risky. If it plays out, if they can deliver the robotaxi, is it exciting? Massively exciting. How long will it take to get there? Can it even get there based on technology risk, regulatory risk, operational risk? This is very difficult to say. So we're still applying an unchanged punchy multiple, but on much lower earnings trajectory.
It's fascinating to see the framing change so quickly, Emmanuel. Appreciate it. Hope you'll stay close. Emmanuel Rosner over at Deutsche.
Holy smokers, that was no joke, because that man is bearish. Oh my gosh. I mean, he's talking about $2 a share in EPS for the foreseeable future, looking out to 2027. What? Oh, that was one of the most bearish people I've seen on Tesla. And I've seen a lot of bears on Tesla. Okay? Then he starts to talk about robotaxi. And here's where things get interesting, right? If they can even pull it off, blah, 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 right? What is a company we know can pull off the impossible time and time again, right? It's Tesla. They're the ones that have done it over and over and over again. People have tried to bet against Elon Musk and Tesla again and again and again to be proven wrong again and again and again. They could never scale a vehicle. They could never not go bankrupt. They could never do this. They could never get to 1 million vehicles. They could never, be successful in this market. There's been a million things they've said over time, and yet they do it. And when I look at how rapidly these self-driving technologies really starting to get better now, I'm looking and I'm like, this is happening much sooner than I think a lot of people realize. And so, man, that was bearish. But that shows you how negative the sentiment really is. I mean, and that man's talking negative about not only this year, but he's talking negative about 25, 26. And FSD's now been lowered to $99, right? Which now the masses can really adopt that technology. Now they had the free trial. And so what do you think is going to happen to their services revenue? Probably going to go beast mode, right? Probably going to go up considerably. Now, everybody else that is selling EVs, almost everybody else, is now, basically setting up their vehicles to be able to charge on Tesla's supercharger network. So that's a whole new massive revenue opportunity, right? I mean, there's just opportunities all over Tesla. There's growth levers all over this company. And people are assuming what's going on in the short term is what's going to continue to go on over the next 3, 5, 7, 10 years. And I'm just like, we have a very different opinion on what's happening over the coming years. The only thing I'll agree on is this is not Tesla's most exciting year, right? It's exciting from the standpoint of we're going to get to see the robotaxi at some point this year, August likely. It's an exciting year in terms of Cybertrucks, starting to go into production. But outside of that, it's not an exciting year for the numbers. That's really 25 and beyond. The numbers start getting really, really exciting again.
On Meta, you see the stock moving higher by more than 3%.
And I think margins are going to start going up in the back half of the year. That's a little exciting, I think.
Let's go to Steve Kovac, who has this news, which is really about the next frontier, Steve, of these large language models, and that is image generation, as we've heard from some others, and now we hear from Meta. What do we know?
Yeah, that's part of the Meta thing. And by the way, this is their new large language model, Scott. They're calling it Llama 3, which is, of course, sequel to Llama 2. Two really important things to know about this, Scott. First of all, it's immediately going to be deployed to billions of users who use Facebook's apps, whether that's the regular Facebook app, the WhatsApp, Instagram, and so forth. So right away, huge user base for this new Meta AI product. On top of that, there's a new relationship with Google here. Previously, they've already have a relationship with Bing, but when you ask Meta AI a question that might need to search the web or crawl the web for the exact right answer, it will either credit Google or credit Bing as the source of that. I asked Meta what the nature of that relationship is, who's paying who, basically. They wouldn't tell me that, but it is also kind of a boost here for Google search and Bing search being tapped by.
I like that. Anybody, you like this one or not really? I think it's a very functional watch. I like the red stitching. Some watch people might not like it.
Large language model made by Meta in order to get you those right answers, Scott.
Yeah, I appreciate that. Steve Kovac, thank you very much for that interesting news moving those stocks. Exactly what we were talking about earlier.
Yeah, 100%. And the open source nature of this is very different from the walled gardens that so many of these large tech giants have historically built. I think it's the smart route. I think you just want mass adoption at this stage, and then you want to take all of that usership and analyze what are people really doing with these products and with these features, and how do we build upon that. So I think we're in the stage where no one's going to own it, because no one really seems to be trying to own it. They seem to just want to get as many people using it as possible. Maybe the products where we get more competitive come in the next wave. But I think this is a really interesting announcement, and I absolutely think you're going to see a ton of notes on this by tomorrow morning.
So what do I think about this? And by the way, you can see Meta stock's the one that's benefiting more from this, right? I think a deal like this is great for both companies. I think it's a great move for both companies. I can't really say as of right now Meta benefits more than Google from this deal. I think it's one of those type of deals that both are going to benefit tremendously from this overall, in my personal opinion. But it's very clear that Meta's trying to build the platform of the future with what they're doing with Llama, and how big that opportunity is, you can't even put it into numbers right now of what that opportunity is going to be over the next 5, 10, 15 years. All I can tell you is it is absolutely massive. It's somewhat similar to an AWS type opportunity long term. And, it's basically not even being valued in the stock right now. I mean, there's a lot of things not being valued in the stock, but that's one of many things not really being valued into the stock. Alrighty, next one up here. Stephanie Link buys DR Horton. Oh, this should be interesting.
Stocks up about 2.25%. And that's after topping estimates, raising its outlook as well. Committee member Stephanie Link, she owns it, and she joins us now with a trade update. So tell us what you're doing with the stock today, Steph.
So I am adding to it. I think the stock actually should be. I'm sorry, I'm hearing a little bit of feedback here. I think the stock should be up more than just 2.5%. And this is a company that just delivered 14% earnings growth, 15% total revenue growth, unit closings up 15%, and their orders were up 46% sequentially. And gross margins were also very good. They raised the guidance, as you mentioned. And I think the important piece here is that 57% of the homes that were bought in the quarter were first-time buyers, and that is where I am very bullish on, because we know that we are 5 million homes short in this country. We know we have 5 million millennials that are first home buyers, and we are seeing that come to fruition. I also like the mix. 51% of their revenues is in the southeast and south central part of the country, so I like that a lot. And at 11 times forward estimates, I think the stock is awfully cheap.
No worries about higher rates.
Okay, so here's why I don't like this, okay? And here's why I wouldn't play the home builders at this stage in the cycle. I don't think you can win in this situation. If rates go down, which at some point mortgage rates will go down, they're certainly insanely high right now. Whenever that happens, whether it's 6 months from now, 12 months from now, 24 months from now, there's going to be a lot of inventory hit the market. And there's some markets, you look at Florida, for instance, there's been so much inventories hit in Florida recently, it's ridiculous. So some markets are already seeing big major uptick in terms of amount of inventory, and we haven't even seen mortgage rates drop yet. Whenever that happens, I think you're going to see another kind of much bigger amount of inventory come onto the market, which is going to make it much more competitive for these home builders, right? They've really benefited from the fact that you have hardly any inventory out there. Secondly, if we have any sort of substantial recession in the next 2 to 3 years, that also doesn't set the home builders up in a good way at all, because home builders usually top 2 to 3 years before a recession. You can look back at the great financial crisis. Almost all the home builder stocks peaked around 2005 or 2006, but it was really a lot of them peaked in actually 2005, right? Well before the great financial crisis actually came. So during that time, you might have thought, oh, home building's great. These companies are making so much money, 05, 06, even into 07. And yet the stocks weren't going up. And you're like, why are these stocks not going up? And then boom, you get hit with the great financial crisis. So I just don't like this setup at this stage in the cycle. I don't think you can win really in this situation. You maybe for a trade, you can squeeze a little bit more out of this over the next, 3 to 6 months. But they're just not the type of stocks I want to be in at this stage in the cycle at all.
I do worry about higher rates, and I think that's one of the reasons why the stock's not up more. But I do think that the dynamics that they offer in terms of that first-time buyer, that's where I want to have exposure, and that plays right into DR Horton. So it may struggle here a little bit in the short term, but I think over the long term, I think housing is a 10-year theme, and so on any pullbacks, I'm a buyer.
Oh my gosh!
And, you also bought
Slow
more
the flip down. Freaking Model S. Going 1,000 miles an hour through the neighborhood. Gonna take a kid out, man. Like, come on. Get real. I'm gonna get one of those little laser guns that like the highway patrol has and time them. Give them a speeding ticket, man. Holy smokes. Thought it was a raceway.
Las Vegas Sands, why'd you do that?
Yeah, I mean, the stock down 8%, I think, is a little overdone. It was a disappointing quarter. I mean, they came in line, but the mix was a surprise. So Macau, which is 63% of EBITDA, that actually disappointed. A lot of that had to do with CapEx and renovations that were a surprise. So they disappointed and they lost some market share. That being said, they still have 27% market share in Macau, and I like that region very much. And then Singapore actually delivered very good numbers. They beat on expectations, and they're benefiting from all the renovations that they've done. So I just think this stock also trading at 11 times versus its 13 times historic. I just think, if numbers are going to come down because of Macau, they're coming down by like 1-2%. I think the stock down 8%. It's a buy.
Yeah.
So I like Las Vegas Sands, but the thing I'll say about Las Vegas Sands, they made a big mistake. Big mistake. You know what it is? They got out of Las Vegas. They shouldn't even be called Las Vegas Sands. They really have nothing to do with Las Vegas anymore. They sold the Palazzo, sold the Venetian. I think it was a huge mistake. They are basically at this point in time, they're like an all-in Asia company now at this point in time, right? Which Asia's a phenomenal gaming market. But I think pulling out of Vegas was a huge mistake for them. They got so much convention business. I mean, their properties were set up so great for conventions, right? They had great properties on the Strip. Were they as good as Wynn and Encore? No. But Palazzo and Venetian, very good properties. They made usually pretty good money out of those properties. They were usually some of the most profitable properties on the Strip outside of Wynn and Encore and Bellagio. And so I think they made a big mistake getting out of Vegas, and I think the stock is not going to be seen as much as a favorable opportunity going forward, because now people kind of look at it as a risk of like it's all Asia play. It's Macau and Singapore, right? You look at a Wynn, for instance, so well diversified. You get the premier properties on the Las Vegas Strip, right? You get they're the operators of the Boston property. They don't own the actual building now, but they're the operators. And then you get Macau. You get 3 properties. So you get the Asia exposure, and you're also, when you're dealing with Wynn versus you're dealing with Las Vegas Sands, you're dealing with the highest end of the market. When it comes to Las Vegas Sands, the only way they ever deal with the highest end of the market for the most part is with their Singapore property, the Marina Bay Sands. Because that's kind of the only game in town, and that property is such an incredible property, they really have the highest of the highest VIP type clientele to that property. But, if you're going to Macau and you're a big time player, you're going to Wynn Palace, man. That's just the way it is. So, anyways, that's just kind of my 2 cents on that. But it's good company overall. I still like it.
Stay in about 18 months for that stock.
Yeah.
You still own Wynn, Jimmy?
I do still own Wynn. Frustrating.
He says reluctantly, I think.
No, the reluctance, the frustration, and Stephanie, I get it. I mean, operational results at Wynn are fabulous, and the stock continues to be lackluster. And, Las Vegas Sands down 8% today. I get it. 2 quarters ago, Wynn reported a blowout quarter on everything.
That's because of rates. Once rates get moving down, everybody's going to want to be in these type of plays.
And was down 9%. It's just part of the story right now. This higher interest rate regime is making people think that maybe the recession's closer. Maybe people aren't going to gamble as much. I don't think that's the case at all. So stick with it, Steph.
Steph, briefly, last word.
Yeah, no, I think I love Wynn. I've owned it in the past as well, but Las Vegas Sands is actually cheaper, and it's a pure play on Macau and Singapore, whereas Wynn, they have also domestic operations. And I know, Jimmy, you like it for the diversification, and they've done a good job as well. So I like them both.
Steph, appreciate you coming on with the update. That's Stephanie Link.
Okay, before we get into Zoom here, these stocks, right, in recession, right? That's why the only stock I want to be positioned in, if we're talking recession, there's only one stock I want to be positioned in that entire space. It's Wynn. It's Wynn. Wynn wins. Wynn wins in a good economy or a good favorable economic backdrop. And they also are the most well-positioned for downturns. And the reason being is their clientele base is the highest end consumer, right? Somebody, if you're a property that caters to people that make $50,000 to $150,000 a year, right, which is certainly not Wynn's main clientele base, but if you're an operator like that, right, which could be much of Las Vegas Sands, type of customers, and then obviously a lot of the Strip. when a recession happens, job losses, man, those companies can really get hit hard. Wynn can get hit as well, but not nearly as severely the way that companies position now. Because if you're somebody that goes to Wynn and you have a $10 million net worth, right? So a big recession comes and your net worth drops to $7 million, okay? You still have $7 million. And you're a business owner and you go to the Wynn and Encore, or you go to the properties in Macau, right? Let's say you're an Asian businessman or, even American businessman. Let's say you make $2 million a year, but a big recession happens, so your business isn't making nearly as much money. So you're making $1 million a year. Your income dropped by 50%, right? You're still making $1 million a year. You still have plenty to go gaming at the Wynn and go on vacation, those sorts of things. Versus if you're somebody that makes $100K and you lose your job and you got to get another job and that job pays $50K, you're not going to the Wynn. You're not going to the Strip. You're not going on vacation, right? There's a big difference in clientele base. So that's why I feel very comfortable being in a stock like Wynn versus, let's call it, basically anybody else in the space. Zoom.
Well, that's Catherine Trebnick. It's great to have you, Catherine. People have talked about the cash, for example, for a while now, but lay out some of the other positives that you see.
So the last month of March, I spent some time at several industry events, and there was really a groundswell towards our booth and the management team's availability there. So a couple of things that I see happening that are happening at a fast...
Hold on, before we go into that, I just want to show you guys why Zoom is so interesting. Forward P at 12 on this stock. It's incredible. PEG ratio 0.5. The gross margins are obviously incredible. The net margins are incredible for this company. So when I look at a lot of the metrics for Zoom, and you look at that income statement, it's a grade A income statement, it's a grade A plus balance sheet on this company. It's actually a very interesting stock here. So upgrade to buy with a price target of $75, bullish on partnerships and AI-based products, risk competition, global volatility.
Pace. One is large organizations.
This outfit is interesting.
That have teams are really keeping Zoom around for the sales and the marketing departments. That's giving them an opportunity to upsell, because one of the trends you're seeing on cybersecurity is the consolidation of these vendors, right? Well, you're also seeing that in communication. They want fewer point products. They have a broad product portfolio. So people are reaching in and grabbing as they expand within the enterprise. They're grabbing Team Chat, they're grabbing AI Companion, they're adding webinar events on. So they're doing a good job of upselling. And the other product that I think that will get a lot of momentum more in 2026, they released a year and a half ago, would be their Cloud Contact Center solution, which grew 300% last quarter. They're going in where they're already established in an enterprise and they might have meetings or phones, and they're going into the IT department or the HR department or the marketing department, and they're running their non-agents are running their contact center for those opportunities, so your marketing campaigns.
Are you seeing less churn to teams? And if so, why might that be?
So I think what you're seeing is stabilization, right? And the stabilization is really because they have a broader portfolio. They have done a better job with their marketing, their channel. They brought in a new channel executive roughly 4 or 5 months ago. He's restructured the program. He's made changes in terms of incentives to the partners. He's added new partners. He's put in-region people to support the partners rather than covering them from, out of state. So I think those are areas that are helping them. Plus, they're just very much an innovation engine. They always have a new product on deck. Every year at Zoomtopia, they offer, hundreds of new features that they bring to the table. And I think their brand. The other side of the point is now enterprise is now driving 58% of the revenue, where 2 years ago it was just 48%. The consumer has less churn, so that's stabilized at 3%, which is really good news. And it improved 40% basis points year over year.
So, Catherine, it's been popular and kind of in vogue to trash Zoom from CEOs. I mean, we hear it. Last week, the Nike CEO said, turns out you can't have big disruptive sneaker designs coming out of Zoom meetings. Are you saying that that's just more talk than what companies are actually doing? Because it's much more popular now to say, back in the office.
Yeah. Well, back in the office, but people are using it externally in their sales and marketing. It's the external communication. It's your voice to your customer. It's your voice for your customer experience, right? The sales and the marketing departments are not turning away from Zoom. You're having Teams be the internal communication vehicle and Zoom be the external communication vehicle. And that's happening, like I said earlier, on a much faster process. And I more companies that I talked to, I was at an event last night. 10 of the companies I spoke to all use Zoom externally. They're large corporations or small corporations. Zoom externally, Teams internally.
So what she brings up there, Zoom's internally, Teams internally, Zoom externally. Yeah, I mean, if I ever think about if I got to get on a video call with just about anybody, they always send a Zoom link. Like, that's just what you do. So, Zoom's got a nice market carved out for it, right? Is it the super exciting stock it was back several years ago during Rona and that excitement? No. But is it a player that's got a great stable business that's very profitable, that has expansion opportunities? Absolutely. And so I actually like this stock. I might start picking up some shares here and there. It's a very hated stock. It's because obviously it's been in a massive downdraft for 3+ years. But you can't ignore the valuation. You can't ignore really the stability in the business model now at this point in time. You can't ignore the balance sheet, and you can't ignore the income statement, right? And so when I take all those factors in, it's actually pretty appealing. Okay, appreciate you guys. Thanks for being here. As always, hope you enjoyed today's video. We're 70+ on the wait list for 1000X now at this point in time. And if you're looking to join the wait list, go to 1000xstocks.com. And you can join the wait list there. Maybe you can be in the top 100 on there. Much love and have a great day.